All right, today we are going to crack open one of the most powerful and, honestly, most enduring formulas in all of finance. It's called the Altman Z-score, and it's a tool that was designed to do something that sounds almost impossible: predict a company's future.
I mean, think about it. It sounds like something out of science fiction, right? The idea that you could take all the messy, complicated details of a huge corporation, all its assets, its debts, its sales, what the market thinks of it, and just boil it all down to one single number that tells you if it's on the verge of failing?
But that is exactly what a finance professor named Edward Altman did, way back in 1968. He developed a model that, a full year before a collapse, could predict corporate bankruptcy with an almost spooky level of accuracy. And the kicker? He did it with just 5 key financial vital signs. So let's dive in. What exactly is this score, and how in the world does it work?
Okay, at its heart, you can think of the Z-score as a kind of financial early warning system. It's a formula that grabs 5 pretty common financial ratios, gives each one a specific importance or weight, and then spits out a single number. And that number is a direct measurement of how close a company is to falling off a cliff.
And this is where it gets really useful. See, the score isn't just some abstract number. It actually sorts companies into one of 3 buckets. If a company's score is up above 2.99, it's considered to be in the safe zone. But if that score drops below 1.81, you are now in the distress zone. And yeah, alarm bells should be going off. And that murky area in between, that's the gray zone, where things are uncertain and you definitely want to be paying close attention.
So what are these so-called magic ingredients? What are the 5 key metrics that Altman figured out were the true vital signs of a company's health?
So the formula looks at 5 totally different parts of the business. First, its immediate cash situation. Second, its long-term track record of making money. Third, how good it is at generating profits from its actual operations. Fourth, how the stock market values it compared to its debt. And finally, how well it uses its stuff, its assets, to generate sales.
First up, we have X1. This one is all about liquidity. The simple way to think about it is, does the company have enough cash and easily cashed assets on hand right now to pay all its bills that are due in the short term? You know, a company with a healthy cushion of working capital is just in a much safer spot.
Next is X2, and this measures cumulative profitability. This isn't about one good quarter or even one good year. Retained earnings are like the company's life savings. It's the sum of all the profits it's ever reinvested back into the business. It's a powerful sign of long-term financial muscle.
Then we get to X3, which is a measure of pure operating efficiency. This ratio basically ignores things like interest and taxes just to see how good the company is at generating profits from its core business operations. It's a raw look at its earning power.
Now, X4 is really interesting because it brings in an outside opinion, the stock markets. It compares the company's total stock market value to all of its debt. So if investors get nervous and the stock price tanks, this ratio drops fast, signaling that the company's safety cushion is getting pretty thin compared to its obligations.
And finally, we have X5, asset turnover. This tells us how much bang for its buck a company gets from its assets. A business that can generate a ton of sales from a relatively small asset base is usually super efficient and in a really strong competitive position.
So we have our 5 ingredients, but the true genius here isn't just what they are, it's how they're mixed together. It's the secret recipe, the specific weight that's assigned to each one. Let's take a look.
And there it is. The very first thing that should jump right out at you is that these variables are not treated equally, not even close. Altman's research showed that some of these vital signs are way more important than others when you're trying to predict failure.
And this was the crucial insight.
See, back then, everybody thought that bankruptcy was all about one thing, having too much debt. But Altman's data told a totally different story. It showed that a company's ability to actually generate profits from its day-to-day operations was a much more powerful sign of whether it would survive or not.
I mean, just look at the weight for X3. That's operating efficiency. It's a massive 3.3. That gives it more than double the impact of the next most important factor, and over 5 times the impact of market leverage. This focus on raw profitability, it was absolutely revolutionary at the time.
So, how did he find these exact weights? You know, this wasn't just a lucky guess. It was based on a really powerful statistical technique.
Okay, imagine you have a big chart, and on that chart are 2 clouds of dots. One cloud represents healthy companies, and the other represents companies that went bankrupt. The entire challenge is to find the one single, perfect mathematical line that does the best possible job of separating those 2 clouds. That's basically what Altman's model does.
He used a method that's called linear discriminant analysis. And the idea behind it is actually beautiful. The algorithm finds a way to look at the data that does two things at the same time. First, it pushes the centers of the two groups as far apart from each other as it can. And second, it squishes the individual dots within each group as tightly together as possible. That combination gives you the cleanest possible separation.
But look, a clever formula is one thing. The real question is, did it actually work in the real world? Well, the results were just staggering.
95%. In his original study, Altman's model correctly predicted which companies would go bankrupt a full year ahead of time with 95% accuracy. I mean, just stop and think about that for a second. A formula from 1968, just using public financial data, was that good.
And the types of mistakes it made were incredibly rare. The most dangerous mistake, a type 2 error, that's when the model tells you a sick company is healthy, which is how you can lose a lot of money, that only happened 3% of the time. This gave the model massive credibility.
And here's the real proof. This wasn't just a case of fitting the model perfectly to the data he already had. He tested it on a completely fresh set of companies that the model had never seen before, what's called a holdout sample. And the accuracy was still there. That proved the formula had real predictive power, that it wasn't just a fluke.
And this thing wasn't just a flash in the pan either. The Z-score has had a truly remarkable and lasting legacy.
The original model was so strong that Altman and other researchers later adapted it. They created new versions for private companies, then for non-manufacturing companies, and for different global markets. The core logic of weighing these different financial dimensions, it just turned out to be universally powerful.
And all of this brings us to a final, really interesting thought for today. We live in an age of incredibly complex AI models that can make amazing predictions. But so many of them are black boxes. We don't really understand why they're making the choices they make. The Z-score is the exact opposite. It's totally transparent. You can look at each part and understand the story it's telling you about a company's health. And that leaves us with a pretty important question. In our modern chase for ever higher accuracy, what's the real value of a formula that we can actually understand?